So markets have had quite the rebound in November, but should you trust this rally? Let's take a closer look at the technicals and the fundamentals to see where markets can head from here. So peak to trough, the S&P has corrected about 11%, which is just a standard garden variety correction. Now we did recently dip below the 200-day moving average, and that probably shook out a bunch of people, but then we started to rally. Now trading quickly below the 200 is not an outright sell indicator, but always pay attention to whether or not we reclaim it. Now, if you subscribe to Elliott Wave Theory, then you were way ahead of this move, as the market often moves in 3 distinct drives before reversing. Now, the October CPI report, which I will get to in a minute, broke us out of this downtrend, and now we are testing the summer highs at 460 with the all-time highs not too far off at 480. Now we are approaching an oversold reading on the RSI, so maybe we could back and fill to this trend line. It's possible, but it's anybody's guess. We did print a weak RSI divergence where we made a lower low in price, but we held on to the same level on the RSI. What I would have liked to have seen ideally is for us to make a lower low in price, but a higher low in the RSI, which would have been a strong RSI divergence. If we back out on the chart a little bit, you can see that we are forming a cup and handle pattern where we have a move down, followed by a shorter pullback, forming the cup and handle, and eventually leading to a breakout. This is a very reliable continuation pattern. What has been driving a bulk of this rally is the fact that rates have been falling. It's also important to note that crude has been falling, and the dollar has been falling as well. Now, I made a video where I dive into these asset classes and how they affect stocks, which you can watch right here. Now, markets were able to make such a strong and rapid comeback for a few reasons. 1, rates went down. I've discussed this correlation between equities and rates at length. In this current environment, when rates go down, equities go up. It's really that simple. Number 2, we had a Fed pause. Now, at the most recent Fed meeting on November 1st, the FOMC left rates unchanged for the second meeting in a row, and Powell had a neutral to dovish tone saying, should we hike more is the question we are asking ourselves. Number 3, the quarterly refunding. Now, the Treasury said that they would sell more bonds at shorter maturities and less at longer dated maturities. This caused long rates to go down, and the market rallied nicely. Number 4, short covering. Many market participants were positioned for a bond market that would continue to sell off. Now, this rapid fall in rates caught many flat-footed, and markets were able to experience a nice short squeeze and rally. Number 5, CPI report. On November 14th, we had October CPI come in at 0% versus 0.4% in September. We want to see data like this because it shows that what the Fed is doing is working, and lowering inflation means less rate hikes, less elevated rates, and even the possibility for rate cuts in 2024. Number 6, seasonals. November and December are generally strong times of the year for the market. And according to the Stock Traders Almanac, since 1950, the SPY is up 1.7% in November, and in the last 5 years, November has been up an average of 4.1%. So at least for now, until the end of the year, the bulls are in control and driving this market. We have rates that are going down, inflation that is going down, a less hawkish, slightly dovish Fed, favorable technicals and seasonals, and what appears to be a year-end chase for performance. If inflation continues to fall, the Fed may have to consider cutting rates, which I believe what the market is pricing in at the moment. But let's keep an eye on rates, the Fed, and inflation going into 2024, as these factors will have a huge impact on markets.